Hey, Mario, great to see you.
Hey Bob, Happy New Year.
Happy New Year. Oh, man, and good riddance to 2022. As you're going to demonstrate today, this past year has had a significant amount of news that impacted the investment community and client portfolios. Our planning helps prepare our clients for this volatility, but the barrage of information still yielded a good amount of fear and prognostication from the talking heads for the worst potential outcomes. We're not out of the woods yet, but as always, government bodies and the audacity of the human race will push forward and will certainly see us through to a better place. So please, Mario, tell us what took place over this last quarter.
All right. So as you said, Bob, there was a barrage of information, to use your term, that happened in 2022. I can't believe it's the third calendar year of COVID. There's so much going on geopolitically. We seem like we're in an economic transition. Markets are crazy. But like always, there are silver linings amid the chaos. And as we kind of like to start off these presentations, taking both sides of the story. We have some reasons for optimism on the left, but let's start with something of the bad news on the right, right? The reasons that there's still some concern out there. First bullet point, we still see high inflation here in the US as well as abroad. We currently see some signals that a recession might be, in our near to intermediate term future. And then with China finally reversing its zero COVID policies that had put a lot of downward pressure on their economic growth. Now, with their releasing those policies or loosening them up a little bit, it's still yet to be seen how that's going to play out and what the implications will be for supply chains and just China's involvement in the global economy. And obviously, we still have some uncertainty around the situation in Ukraine.
Yeah.
Now, on the bright side, on the left side of the page, here in the US, inflation is still high, but it looks like it's coming down. The third bullet point, we still see pretty strong economic data. We'll go into this in a minute, but including the labor market, things like that, it really is sort of giving us reason to understand that we're not in a recession. And if things keep going the way they are, maybe we can avert that. The second bullet point is probably better stated on the next slide, which is that unlike the recent past, bonds seem to be fashionable again. If we turn back the clock to a year ago, yields on our bond portfolios were low single digits, 1%, 2%. But given the turmoil in the bond market, we can now expect to get some better, more historically accurate or historically aligned returns from our bond portfolio.
Yeah, which I'll just interrupt for 1 second, Mario. I mean, I've probably said this in previous quarters. This is helpful to a lot of our clients that are savers that have a fair amount of fixed income in their portfolios, and the largest majority of the investment outcome or return for a fixed income portfolio is the yield, the coupon. How much is going to be paid for that bond? And while they were trying to grow the economy in extremely low rates, that was a headwind for a lot of people. It had to rely on the equity returns, and if you have a low equity allocation to your portfolio, it muted the outcomes. And so, hopefully, these higher yields will help some of our savers.
Absolutely, that's exactly the point, and hopefully, we have the negative returns from bonds in the rearview mirror.
Yeah.
So the next page that you're going to see is very busy. We're certainly not going to dig into every number, but it is pretty useful for dissecting US inflation numbers. So I want to call attention piece by piece. The first two rows are the CPI, which is Consumer Price Index, the most widely known number for inflation. And in fact, it specifically shows the year over year number. So if you look at the right side of the page, you see the November inflation data. And yes, this is reported on a lag. We will be expecting new numbers to come out in the next few days, but that'll just be the December number. So the top two rows show you inflation that was reported, basically the increase in consumer prices as of the most recent November relative to the previous November. right? So that calculation can be problematic because some of that growth could have actually come in the beginning part of that 12-month period. So you see the November numbers are yellow and orange, indicating these aren't such great signals, right? These are less than ideal. If you look at the third and fourth rows on this page, you're actually looking at the month over month number. And that gives you a little bit more representative number of what's happening more recently. So in this case, the November number says, what was the price change from a month ago?
Yeah.
So if you look at it, you're actually seeing more of the greens and yellows more recently, indicating that the more recent inflation numbers are more in line with expectations and less scary than if you just looked at the year over year numbers.
Yeah.
So hopefully that continues, right? But if you look at the, go ahead, Bob.
No, that was it. This is a great, I'm glad you're breaking it down this way.
Yeah, and I think it's kind of a disservice by the financial media for not breaking it down this way, and that's why we wanted to call attention to it. If you look at the rest of this page, the bulk of it, it sort of divides month over month inflation into all the different components of that inflation basket. And if you just look for the red blotches, if you will, you could see that in early 2021, we had inflation in the goods sector. And I already mentioned China. This had a lot to do with COVID policies and supply chain disruption and things like that. Then as you move to the right and get into more recent periods, you see it was food and energy that had more of those reds and oranges, and that corresponded with the Ukraine situation.
Yeah.
And that's already starting to abate into the greens and yellows to a degree. But right now, the bottom right side of the page is showing that a lot of the current inflation is happening in the shelter areas, right? In particular, rent or the cost of primary residences. And that is a big bulk of the consumer price index. So the question now becomes, for each individual consumer, their particular housing costs might not necessarily reflect the inflation in the overall basket. And so we might not necessarily need to get caught up in published inflation numbers because not everybody is experiencing that equally. And we may actually see inflation stick around in terms of the numbers because rent tends to be sticky. So we definitely agree that, or feel like you need to dig into this information to really understand what's going on.
Yeah, that's great, Mario.
All right, so that's the US picture. If we turn the page, it's going to look very similar. But what we're showing here are year over year. Here's that problematic year over year calculation, but definitely the most accessible. But in this case, it shows you not just the US, but different countries and regions around the world. So if you look at the far right, you see a lot of red, right? In this case, it's red versus blue, hot versus cold. You see a lot of red with the exceptions towards the bottom of the screen, and the one notable exception being China. I think we've talked about China on every slide so far. The COVID policies really have had a dampening effect on China's economy, and a slow economy tends to not generate inflation. So the question is whether or not China's inflation will spike while hopefully the rest of the world starts to moderate or continues to normalize. Now, back at home, flip-flopping, home, global, back here at home. Actually, no, this is a more global slide. My apologies. So in terms of policy decisions to combat inflation globally, this particular graph aggregates interest rate increases and decreases, or hikes and cuts, by 10 different central banks by calendar year going back to 2003. At the far right, you can see essentially the unanimous increase in rates last year to combat inflation around the world. And not since 2008 did we see such a coordinated response, but that time it was in the other direction, and it was in order to combat the problems caused by the financial crisis. Now, where will the Fed go from here? Again, back to the US. This slide is a graphical representation of the operative phrase that you may be hearing in the media: pace, pause, and pivot, meaning how fast will the Fed continue to raise rates, or will they slow it down? When will they stop raising rates? And when will they pivot, or if they pivot, to decreasing rates? When would that happen? So if we look at the pace, the pace of increases in 2022 was among the fastest in recorded history, though their recent 50 basis point increase was lower than the previous three 75 basis point hikes. So the pace appears to be slowing. The pause button, that's on the horizon, but it's a little bit too early to call, and the Fed isn't really signaling very clearly when they expect to stop the rate hiking cycle. And then the pivot, way too soon to determine if and when they're going to cut rates, especially because they keep signaling a strong preference for overshooting in terms of the Fed funds rate in an effort to kill inflation.
I'm going to pause here.
Good one, Bob.
Take a minute just to touch on this, because this is, these are, again, coming back to the value of having an ongoing relationship and planning relationship with a investment firm, a financial planning firm, because having regular meetings, these are the types of conversations, not necessarily about what the government's doing, or even in that the inflation graph that you showed about how a company may digest that information and decisions they need to make to adjust to the new information that they're receiving, and how to either pause or pivot or whatever they're going to do. But this is the kind of conversation we may have with a client and say, okay, you have a goal to, take an around the world cruise, or you're going to, renovate your kitchen for $100,000, whatever that may be. Well, either the money's sitting there and it's ready to go and we can pull the trigger, and it's, maybe the cost of goods have now come in line and you can go ahead and do it. But it's the ongoing dialogue that impacts your well-being, because all this conversation that we're having here, again, it's in the rearview mirror. It's hindsight about what has happened. We're not prognosticating about what's going to happen. And I know that's not your tone. That's not what you've been doing here. But again, I just wanted to say this was a good representation as I see it now. This is a dialogue that's good to have in your house, with your planner, with your investment advisor. Okay, what are we doing for ourselves based on, where we are at? So thank you. I just wanted to interject there for a quick minute.
Yeah, no, that's great, Bob. I appreciate, we sit here just looking at investments, but it's very important to bring that home, to what really is meaningful and impactful for, the investor who's being bombarded with this information and having to make very personal and important decisions with your help. So that being said, maybe a strong presumption here that some people are interested in and wondering whether we're in a recession or whether one is coming. A lot of times when we hear recession, some folks just take the easy definition of, the economy contracted for 2 straight quarters. And that's, it's okay to think about it in that way. And it's an important data point. But there's really a lot more that goes into the true definition of a recession. And at the left side of your page, you see the actual factors that go into that determination. We're not going to go into anything, very specific on any of these, but you can see that solid red column in March and April of 2020, where all of these indicators solidly said we were in a recession. That was really when the COVID lockdown started, right? Now, look all the way to the right, and none of the factors that determine whether we're in a recession are red, let alone 1 or 2 or all of them. So we just want to make sure that people are understanding that the media tends to hype up bad news, right? That tends to get us nervous. And yeah, it's not all roses, but in terms of the true definition of recession, at least as the current numbers are coming in on a lag, we haven't been in a recession. And the indicators don't seem to have been deteriorating since that period of time.
Yeah, the television, the media is paid by the number of eyeballs. So telling a muted story is not going to raise attention. I remember years ago, we used to turn on Channel 6 News or whatever, and you'd get what transpired throughout the day. And then before you know it, it's about fires and famine and shootings. And it's like, what really dramatic elements and painful elements. And now it's, there's investment channels all over the place, really expanding the perspective and I'd say dramatizing a little bit to some extent what's going on, and it's not good for anyone's health. So
Yeah, it's funny you mentioned that. I'm sitting here. You may know this, and we may have talked about it, but my family has like in-laws have a place in Maine, and we get their local paper, and you see, feeling good stories,
yeah,
or Mrs. McGillicuddy's cat was rescued from the tree. It's not the fire and brimstone that you see on the national
yeah,
media, and
the
that kind
news is not the news anymore. It's sensationalized entertainment about what's going on out there, and if you can just diffuse it a little bit, you might be in a better spot.
Exactly. This slide is all about predictions
Okay,
and the
yeah,
fallibility of prediction. And, certainly the firms that you see on the left side of the page have a financial interest, and their clients want to see that they're paying attention, or they know what they're talking about. And part of the way they think they can prove they know what they're talking about is by making predictions. And, we talk about this at the beginning of every year, how incorrect most of those predictions are 12 months later. So what you're looking at here are 6 major financial institutions in the US. The middle column was their prediction of where the S&P 500 would finish 2022. Now, it started around 4760, right? So if you go down the page, you can see that 4 out of 6 of these firms predicted an increase. We know that it didn't even increase. So they were wrong directionally on where the market would go. Bank of America and Morgan Stanley at least predicted a decline in the market. But if you look at the right side, you see how far off those predictions were. And in 4 out of the 6 cases, they were off in direction and over 20% in magnitude. So in hindsight, what was the value of paying any attention at all to this forecast? There's none.
no,
And that's not a part of what we're about here at Novi. We're not about making predictions. We don't time the market. We don't make investment decisions based on expectations. And this is just proof as to why. I mean, these companies they have entire teams of economists and PhDs and investment specialists, and even they can't get it right.
no, but there's still people out there that believe they can do their enough analysis to predict what's going to happen going forward, and man, it is really hard. So we don't opine by it. We choose to do solid, comprehensive planning and find a portfolio that's designed around the amount of risk that you can take, and try and stick with it.
Yep. Now let's go into showing some pictures about how that risk actually materialized last year.
Mm-hmm.
It won't be fun, but we need to talk about it.
Yeah.
So what you're looking at here is the rate of return of different components of the bond market. We talked about the good outlook going forward. Well, part of that good outlook is because of where we've been in 2022. So on the right side of the page, you actually see the negative returns that the bond components that we follow experienced last year. And in particular, you see that the larger negative numbers were in the corporate bond market. They tend to follow more closely aligned with stock market returns. Treasury bonds perform poorly, mostly due to the pace of the Fed increases. But even stodgy conservative investments like municipal bonds could not escape the negative returns of last year. The left side of the page shows you their experience in the fourth quarter, when investor sentiment tended to come back around, looked like inflation was coming under control, and a lot of the bad news had already been priced in the market. So we did see a little bit of a rebound in the fourth quarter. We'll see that again when we talk about stocks. But ultimately, for the year, the bond experience was not so great. To put that into perspective, I think not so great is probably an understatement. What you're looking at here are essentially the calendar year returns for bonds back to 1980, although they're arranged from the worst years at the left to the best years at the right. And you see that very far left-hand observation, last year's bond market down, was it 12, 13%? We just saw in the previous slide. You could see it was by far the worst calendar year in over 40 years for bonds. But again, the silver lining is that when bond prices fall, their forward-looking yields go up. So from this point forward, we should expect a better rate of return. And I think we talked about this before. I would rather have a minus 12% year and then get 5% from bonds in perpetuity versus stay where we were a year ago and get 1 or 2% from bonds in perpetuity. It's a painful first step, but the math works out in your favor to experience it in this way.
I got to say, money has been too cheap for too long, and it's getting some normalization. This, with if we go all the way back to all the amounts of quantitative easing that took place, and there's still a lot of concern as to what would happen when we try to unwind all the debt that's been created here, and that's. They're raising interest rates, they're stopped buying back any of those bonds and so forth. So that's slowly reducing the amount on the books for the Federal Reserve and so forth. So it's like this is not a surprise, but I don't think from our perspective, the overall damage to a client portfolio, I think, we're seeing a range between 8 and 10, maybe 12% down for last year on diversified portfolios. That's pretty good for the number of years that we've had really, really positive outcomes and good returns on client portfolios. So we have to expect down periods in the market, and this one happened to come both at the same time, which which you're about to display, I think, is the equity side. But having them together was a little more painful than just one side or the other.
Yeah, absolutely, definitely made last year different than previous periods.
Yeah.
I think we have one more slide for fixed income before we pivot to equities. This slide, again, we just looked at the US experience. We know that, our portfolios are diversified, not just on the stock side, but on bonds as well, where we believe in, diversifying away from just the effects that the US economy feels, and in particular, the investments in our bond portfolio. So what you're looking at here, in particular, the blue dots show you where the yields were on various countries' bonds at the beginning of last year. And the top of the column or the bar is where they finished the year. So now we're seeing, instead of, yields across the board of 1.5% or less, now we're seeing yields internationally and at home between 2.5% and 5%. So it's not just here, it's happening around the world. Our global diversification is and is expected to be paying off. And if you also top this off by the notion that within those bond portfolios that we use to access non-US exposure, you can actually add return by the hedging process, as well as, and hedging currency, which we do. Our managers do that. And by owning not just foreign government bonds, but also other types of issues in these other countries, like corporate bonds and things like that. So bright spots across the board in the bond market. Yeah. And now turning our attention to stocks. If you look at the right side of the page, you see that 2022 was a pretty rough year for them as well. But if we dig into this a little bit deeper, and if you've tuned in before, you know that this chart breaks down the U.S. stock market in terms of the size of the companies, which we define as, in this case, by large versus small companies, as well as investment style. So are you taking a growth-oriented investment style, which tends to favor companies whose expected profits are far off in the future, or do you take a value-oriented strategy, which tend to have investments in more fundamentally sound companies who happen to be trading at a discount today for some reason or another? Maybe it's they're going through a particularly tough quarter or something like that.
Reorganization, whatever.
Exactly. Yeah. So, you see the gray and green bars for the two right columns, see pointing downward and to the greatest magnitude. That represents growth stocks. And while the timing of their underperformance was not predictable, it's really understandable why they're underperforming. We've already talked at length about rising interest rates. You mentioned the cost of money or the cost of capital. Well, if you have a growth stock or a growth company
Yeah.
whose profits are way off into the future, well, there's a time value of that money. And if the discount rate or the interest rate that you could otherwise be earning on that money is higher, that diminishes the value of those far-flung assets or far-flung profits. And that's why we saw growth stocks taking a hit like they did last year versus their value counterparts, which are the yellow and dark blue, which held up better and which actually spiked a lot better in the fourth quarter, as you see on the left side of the page.
And this, just everyone's aware, is just
Sorry, Bob.
domestic. That's fine. That's all just domestic U.S.
That's
not
correct.
any
Yep.
foreign investments.
Correct. So we dove into the U.S. market by size and style. This is a different way to dive in, and that's by sector. So we already sort of alluded to this, but at the bottom of the page, you see those growth-oriented sectors like tech and telecommunications. They underperformed the rest of the market, -8%, -4%, that sort of thing. Where value-oriented or traditional value-oriented sectors are more towards the top. Your energy stocks, utilities companies, your consumer staples, the companies like Procter and Gamble, and companies that make, food staples and things you're going to buy no matter what, no matter how tough the economy is. Energy at the very top, with the only meaningful positive return by sector last year, also got a bit of a bump during the rise in energy prices that were a result of the Ukraine and Russia situation earlier in the year. And now we do turn our attention away from U.S. stocks into non-U.S. markets. In this case, the returns were as good or as bad or better than that of the U.S. Their U.S. equivalents. So all in all, diversification did pay off last year, but especially in the fourth quarter. Part of the reason for that outperformance was the recent decline in the U.S. dollar, which had previously been a headwind for our international stock exposure. And we'll talk about that on the next slide in a little bit more detail. But one underlying story besides currency, which we've mentioned a couple times now, is that of China's experience. China represents about a third of emerging markets, which is the grayish bar on the page here. It's also among the world's largest economies. So, how China goes does impact a lot of what goes on in the global economy, as well as finding its way into stock returns. So not only do China's stock results drive emerging market returns as a whole, but it also, it's going to matter how China comes out of its, COVID lockdown policies, and we'll have to sort of wait and see whether the rebound will find its way into their economic outcomes, health outcomes, and how that flows into stock market returns.
Yeah.
I mentioned currency, and this is a chart we always like to include because it offers a lot of educational opportunities. The top part of the graph shows you how the value of the dollar has changed versus world currencies over about the last 20 years. The bottom part shows you how the dollar has performed over the last quarter. So if you slice the top part of if you slice the top graph in half and look at the right side, you see that the dollar has been almost on an unabated upward trajectory for about the last decade. And that's partially why we saw U.S. stock returns doing better than international. International stock returns could do just fine on their own, but because we're a dollar-based investor, the currency that non-dollar investments are denominated in and its performance has an impact on our portfolio performance. So again, last decade has been a strong one for the dollar. But if you look at the bottom graph, the last quarter shows you that the dollar has depreciated. And that, again, has been a little bit of a tailwind for our non-dollar denominated investments.
All right, Mary, I'm going to put you on the spot. How do you predict which direction the currency is going to go?
I'm going to joke with you and say, weren't you listening earlier in the presentation?
Yeah, well, the only reason I asked that jokingly is where you said if you split this thing in half If you looked at the previous 10 years, as long as you stayed, through the entire cycle, you'd be back to where you were. Now, that's a long cycle to ask, but most of our clients that are in their 50s or 60s or even younger than that, if you ask them how long they're going to live, they typically were going to say probably more than 20 years. But their investment perspective is always shorter than that, always over the next quarter, 6 months, year, 2 years, whatever the case may be. We tend to want to look at things over a longer term horizon, and we can't predict which cycle is going to go one direction to the next. And that's why we use a globally diversified portfolio and have international and emerging markets investments in the portfolio. Could we smooth the ride by hedging? We could, but that's a drag. That adds expense to the investment portfolio, and would hurt overall returns on the long run. It would shift this whole thing down by the magnitude of the cost of trying to hedge. So anyway, it was a joke, but just trying to get people to see the broad perspective as well, that, okay, if you stay in this, maybe we'll experience, I can't say where we would have been from 2001 to 2012, so that international investments will get a little boost from a weakening dollar.
Yeah, absolutely. And I'll just add to that, that we are all dollar-based consumers, right? I presume the majority of your investors, your clients are not, living abroad with their consumption in euros. So if we're a dollar-based consumer, then a declining dollar makes all the foreign goods, whether they're made in China or Sri Lanka or wherever, makes them more expensive. So if we only had dollar-based investments, and all the stuff we buy is getting more expensive, then we'd have no natural hedge. So by owning non-dollar denominated assets, it balances out both sides of our ledger as consumers.
And it is a global economy. So.
That's right. Yep. So that actually concludes the prepared remarks. And I know the majority of this presentation is focused on investments, but the items on this page are more of the beliefs and actions that investors can control. You and I know, and most of the folks listening might have heard before, that investment performance, it'll ebb and flow, but we don't want to let that distract people from their financial plan, taking the action steps necessary to see those plans to fruition. So I'll turn it back to you to close us out, Bob.
Yeah, I mean, sitting face to face with our clients, or whether it's through video like this and hearing about what's going on in their lives and what they need to plan for, that's what we're trying to alleviate those concerns. Where's the next dollar going to come from? I mean, most people, they come to us and they have a paycheck that they've been receiving for their entire life, and they're now going to be reliant on what this information is coming on a daily basis. So it's much more important to them. So, it's important not to just listen, turn on the news, hear these prognostications that the world is, coming to an end, or whatever they're going to pitch and preach, and go in ebbs and flows. I remember, just to step back for 1 second, we were getting a barrage and thankfully it didn't even come up in the conversation until now, about cryptocurrency. Well, it's starting to fade. Because there's been a huge implosion with FTX and a number of, a couple other huge elements within the crypto world. And who knows, it may play a role at some point in time. But before, we always saw it as speculation. We could not understand where the value of that was going to come from. And thankfully, we just avoided it. We needed to create the highest probable outcome for our clients. And we didn't see how adding cryptocurrency to our client portfolios was going to increase the probability. So anyway, that's our primary focus and objective. And we're glad to have you, helping us guide this path, Mario, with your insights, and just keeping the research part top of mind, and making sure we have the right investments in the portfolio, the right mix of investments in our portfolios, and then we're making sure we get it implemented properly. So thank you. That's it.
We appreciate that, Bob. We value the role that we serve, and we're here to help. So let us know anytime anything comes up.
All right. Thanks, Mario. Thank you, everyone that listened to the end. Have a great 2023.